All right, so it's just about 12 o'clock. So just want to let everybody knows who's joining the webinar here that we are recording this. So I'll probably be posting this here later on YouTube as well. So those who couldn't attend would be able to do so. I'm going to try to keep this video or webinar short. So what I'll do is if you have questions as we go throughout, just go ahead and put those questions into the chat box. And then after I get through the presentation, I'll go ahead then and stop the recording and we'll address those chats afterwards. That way, those of you who are trying to keep to a schedule can get all the content and not be held back on that. So feel free to put those, again, questions in the chat box. I'll get to those at the end. For those of you who don't know me, I'm Joshua Kittle of Cross Country Mortgage. I've been doing this for lending for about 19 years. And for the last 4 years, I've done these kind of forecasts each year of kind of where I see the market going. So it's one of my favorite things I do. I do a lot of education, but I like to just kind of talk about the forecast. And so that's what we're going to do today. So again, thank you to everybody who has joined. And let's just go ahead and jump into this. All right, I'll get my slides turning here. All right. So today's agenda, first, let's just start with a recap of 2022, find out whether or not my forecast was any good. And if it was horrible, maybe you guys should check out right now and save the time. So we'll check that out. And then I want to get into some market fundamentals as to why I think rates will do what they do and why housing will do what they do. It might be a bit technical, but again, the idea here is to understand why I think what it's doing. And these aren't just like throwing darts or looking at a magic 8-ball to figure out what the market's doing. There is telltale signs that give us very good ideas where the market might go. And then at the very end, I think also the last few slides, we're just going to talk on based on today's numbers, where interest rates are today, where house values are today. Should a person buy or should they wait? And should they rent? What's the benefit there? And if I think rates are going lower or home values going lower, again, should a person wait? So we'll just do a few quick tools that might help people understand that for them. Okay, so let's jump into it. So 2022, I forecasted that I thought interest rates would be about 6.25% to 6.5% throughout 2022. Actuality, we did actually see rates go higher. They went to about 7.5%. By December, they were back down to about 6.5%. So it was a miss, but I'm going to call it a near miss because I did talk a lot about last year how October was the key month, and we would see rates continue to rise until we got through October, but they did actually go a little bit higher. The other thing I want to point out here is typically when you see rates being quoted online and Fannie Mae says the average 30-year rate, that's a rate of about a 1.5% discount fee. And so there's lots of different interest rates. And so anybody who got a loan in October may have paid more or less. It might have to do with what you did for discount fees. So that was, again, I think a near miss, but given the change in the market, and keep in mind that in October of 2021, rates were around 2.5%. So to think rates going from 2.5 to 6.5 was already a pretty bold prediction. Now, what about housing? I said housing would remain strong in 2022, but because of raising rates, we would see demand soften compared to what we saw in 21. But by the end of the year, I felt that we would still see very strong home appreciation at 9 to 10% coming off 2021, where it was around 20%. So definitely a reduction, but still very positive, and a lot of wealth creation happens when you got that kind of growth on a house. In reality, nationwide, we did see housing stay strong through July, but as rates got higher, that definitely had an impact on housing, and we started to feel that cooling effect and that slowdown. But still, year-end, the year-over-year national average for home appreciation was 9.2%. So right on the lower side, but right with where I was expecting it to be. And I think it was a good housing market. It may not feel like that now because coming off of the summer months with high rates and the change. But keep in mind that even in December, on average, homes sold within 24 days. And I just find it very difficult to say that you can call it a bad market when you have a 9% appreciation and less than 30 days to sell a $500,000 asset. So I think housing did stay strong. I want to address really quick some of the garbage we see in the news, some information that's being out as far as what the news says we should expect here for 2023. And I'm kind of going to give you an idea of already where I think rates are going. They're going to improve. But Here's what I just got. These are in the last 2 to 3 weeks, headlines that I saw. So according to letters sent out to Goldman Sachs clients, they're advising their clients their prediction for the 30-year to remain high at 6.5% at the end of the year of 2023. This one here, this is a video I just did on this one. It'll go on my YouTube channel here today, but it's actually tomorrow. But it's the title of the article was a housing report done by NerdWallet, and it basically said 67% of Americans expect a housing market crash is imminent in the next 3 years. And you'll check out my video why I don't like this, but really short. It was 67% of Americans polled, not all Americans. Nobody called me. And I don't know how you can call it imminent and 3 years the same thing. So, but this is again what consumers are reading and painting the picture that I believe is false for the housing market. And last but not least here, Moody's forecasts a peak and trough decline in home values of 10% in 2023. So that would be right on the edge of what you might call a market crash in housing, more than a 10% decline. And again, because of this type of information, consumers are looking at this and they're thinking that maybe if they wait to buy, they can buy for cheaper, or that they think rates will stay high, and it's misinformation. So let's dig into why I think these are wrong. So I first want to talk, and again, this is going to be a little bit more on the technical side here, but bear with me. I want to talk about the correlation between the 30-year note versus the 10-year treasury, and something that a lot of people don't understand that impacts pricing on mortgage rates, called service relief premium. Now, the reason I want to use the 30 versus a 10 is there's a correlation between how these two financial instruments trade. Even though you might be getting a 15-year, 20-year, or 30-year loan, Wall Street, big money, knows the vast majority of those loans will get paid off for one reason or another in around 10 years. So comparing a 30-year note to a 10-year treasury, where the 10-year treasury is considered a safer investment because it's assumed to never default, it's got the federal backing, compared to a 30-year note that you could have default. And so there's a correlation here. And this is all going to be setting up to this next chart we're going to look at. Now, the other thing is the service relief premium. What this is when mortgages are packaged up, they're sold into the market called a mortgage-backed security. You probably hear about that. So it's a pool of assets. Governments buy these assets, financial companies, hedge funds, pension funds, and our federal government buy these assets as part of their investment. But they don't want to collect the payments on those. They don't deal with collecting the mortgage payment. They don't deal with foreclosures, loan modifications, paying taxes, paying homeowners insurance. So for that, you have a service company. Think of that like a property management company who's going to handle that for the landlord. Unlike property management, though, the servicers actually pay a premium for that right to service that package of financial instruments. And they get to earn a fee on that package over time. In a normal market, servicers, what they pay the market, which again gets priced into the lenders, because once the lender's done the loan, the company then sells out into the market, and part of their revenue comes from selling that into the market and getting that service premium, and that gets factored into ultimately what the consumer pays. Well, if the in a normal market, the servicers will take about 3 years to break even. And then from about 3 years on, they get that profit. So figuring that the loan's gonna last 9 to 11 years, they're willing to pay that upfront premium with the expectations of earning that money over time, okay? So now let's jump into this next chart here. What this chart shows you is a relationship, a normal relationship between that 10-year treasury and the 30-year. And normally, while they don't trade exactly the same, there's a relationship about 1.75% to 2% gap between them. Whenever they, moments they get kind of spread, say the 30-year goes up, at some point it goes up high enough where the risk to the market to take that higher rate of return, even though it's a riskier asset, it makes sense. So money flows into there and it pulls that back into range. Or if the 10-year drops too much, then again, there's no money in the 10-year and it balances out. If you look to the far right, what you'll notice is in 2022, we saw that spread really widen. What that correlated to was the servicers were no longer willing to pay the premium they once paid for the right to service that loan. Why? Because they did not think that those higher interest rates would stay around very long. And if they were to pay the normal premium to purchase that pool of assets, they strongly believe that they would not have those loans for 3 years, and they would see a huge percentage of that portfolio roll over through refinances in less than 3 years, and they would lose the money. So what that equated to for our consumers, home buyers trying to get rates or refinance, is not only were they getting higher interest rates, but at a higher cost. And the ability to offset that cost by taking a higher rate went away. You had to really go way up high on that rate sheet to get to any point to where you kind of didn't have to pay a discount fee. And so in a normal market, a lot of clients might take a credit or go what's called par pricing. They didn't pay a premium for it. And the par pricing and the ability to have a credit to offset the closing costs, it just wasn't there because of this evaporation. So this tells you that servicers believe that rates at 5.5%, 6%, and 7% has no value to them because it won't stay there. Now let's move on to inventory or inflation. So inflation is key to why I think rates are going to do what they are going to do. It's also, if you go back to 2022, why I predicted rates going up, it was all tied to inflation. Inflation is really, I think, a key thing. There's other mechanics in here that can impact the market, but this is a key one. So let's jump into this. And inflation drives mortgage rates. And it makes sense. I mean, think about it. If you're lending money and say inflation, as you can see here in 2018 through 2019, that lower line, that pink line, that's that CPI, that consumer index, which is one of many inflation readings, staying low. So if I think inflation stays at 2.5%, I can lend money at 3.5%. I'm making money, especially if I can do that in large quantities. I'm making a good rate of return. I've got more buying power. And what you'll notice is if you look at this, you can see how the when COVID came out, we had a sharp decline in inflation because everything was closed down. There was nowhere to spend money. And so cost of everything came down. And at the same time, we see inflation. Now, this white bar has to do with the Feds manipulating the market and stimulating the housing market. I do want to take a moment, because this gets so misunderstood, to explain what the Fed's fund rate is. This is not what we're talking about in this QE line. It's not the Fed's fund rate. Every time the Fed's fund rate changes, I get clients and realtors alike reach out to me and saying, hey, I hear the Fed's going to raise the rates again. And they think that that means mortgage rates are going up. And if that was the case, you'd only see mortgage rates change every 6 weeks, but that's not the case. They change daily. The Fed's fund rate is the rate in which the Feds lend financial institutions to balance their books overnight, very short term. So let's just say you have a bank and you're allowed to leverage your money on a 1-to-10 ratio. So every dollar deposits I have, I can actually lend $10 against that dollar deposit. Well, at the end of business, based on my ratios, perhaps now I'm at $1 deposit to $11 of loans. I'm out of compliance. I can go to the Fed's fund window, borrow money to balance my books overnight. And then again, tomorrow we do it all over again, depending on what happens with deposits and loans and stuff. So that's what it's doing. When the Feds lower the Fed's fund rate, that makes it very, very cheap for the banks to borrow money. So they will get very aggressive on lending money for car loans, credit card debts, home equity lines of credits, all kinds of things. And so you see those things get cheaper. But when the Feds raise the Fed's fund rate, that changes. Mortgage rates, on the other hand, are an instrument that's traded on the open market on stocks. And so it doesn't react directly like that. And in fact, in most cases, when the Feds raise the Fed's fund rate, rates get better. Rates are better now than it was in October, yet the Fed's fund rate's higher. So this, I know it's a long explanation, but it's really important because, again, so many people get that wrong and the news reports on it wrong every time, or they just don't explain it. Now, that white bar, what that is the Fed's manipulating interest rates by doing what's called quantitative easing. They purchase billions of dollars of mortgage-backed securities. So supply and demand. They went in there and they were willing to buy up all the rates they can loans they can get at 3%. So that drove rates down. Even when we started seeing inflation skyrocket, you can see that here. Everybody knows at the beginning of January 2021, I don't know why the Feds felt necessary to stimulate the housing market with low rates, given what we had in 20, but they did. And we see this huge shoot up here as inflation finally started coming through. The Feds at first kind of thought it might be transitory. They just didn't think it was really something to be worried about. Well, when they finally realized it was, and they finally took their foot off the gas on the housing market and they backed out of the easing, so they're not adding to their books. They weren't buying them mortgage-backed securities like they were. Sure enough, now the open market had to respond and rates shot up because, again, until you get this blue line above the pink line, you're losing money on that scenario. Inflation's eroding your buying power. You'll notice here at the end of the year, we saw a turnover. Okay, so there's your correlation. You can see kind of how rates respond to inflation if you're not manipulating the market. So when will inflation peak? I actually think we've seen inflation peak already back in October. And the reason that I was saying all last year, and it wasn't just me, all the smart money that understands this was saying that rates were going to have trouble until October, but then we should see a pullback. And that has to do because inflation is a 12-month rolling cycle. So every month when we get the new number, we drop off, 12 months ago, the old January number drops off, new January number comes on. So you can look at the month over month, December to January, and the year over year would be looking at the last 12 months. Going all throughout last year, we knew we had high inflation. You saw that last chart, inflation was shooting up, and we knew we had a really difficult summer because a year ago, we had really low inflation. So knowing that in June, we were seeing signs of a high inflation, 0.8, and knowing we're going into months where we're going to have low numbers drop off, the year over year numbers were going to look ugly. And sure enough, it did until we got to October. By the time we got to October, we got back to now several months of these higher inflation rates and the impacts of the Fed, lowering the raising the Fed's fund rate, which makes cost of borrowing more expensive, slowing down the economy. These effects are are coming into play now. And so we saw low numbers. So October of 0.6 replaced by October of 0.3. And you can see very favorable numbers here. So we just got yesterday the new readings, and it wasn't as it still showed some improvements, but not very much. And we're going to take a look at why that was. So before I get to the next chart, I want to talk about one of the key components of the inflation numbers that's important to understand. And again, we'll play into where we think rates are going here on May 10th, which was the date you saw circled. So like last time, October was the date we wanted to watch. Now May is the date we want to watch. Within the basket of goods, so inflation is measured by a bunch of basket of goods, food, energy, all this kind of stuff. But a key component is what's called the shelter component. The cost of having a roof over your head, whether you're owning a home, you're renting a home, you're staying in an Airbnb, hotels, whatever, what's the cost to stay somewhere? That makes up 39% of the core CPI. And they actually just changed a bunch of things and how they're doing these readings. And it actually has an even higher rating now, which I think is around 43%. So understanding within the inflation numbers what each component's doing can help you project what's going to happen in the future. So the problem with shelter is it has a lagging effect. It's kind of like this roller coaster. On one hand, you can say the roller coaster is going down. On the other hand, you can say the roller coaster is flat. But you can also plainly see that the guy in the very end, he's still going up. So it's this lag effect. So we know that real shelter costs today are going down. However, as we report here in their numbers, it feels more flat, but the actual number readings, probably not explaining this very well, but when you look at the numbers in January, you're actually getting this effect in here. So it's making the housing component or shelter component look high and keeping the inflation numbers higher than they otherwise would be. So why May 10th? This top chart here is that chart that we just looked at that shows that rolling 12 months. And these green arrows here are good, red is bad. And you can see that coming up on April 12th, when we get the May reading, because everything's a month delayed, March, and we get April's reading for March, we have a very low CPI. So that's going to be a headwind. That's not good. Although within that, we had a very high shelter component, and that's good. This is February 14th, what we just got. It was a soft number. And again, we had a high number to replace. So that was great, but we had a really low shelter component. And again, looking at that roller coaster in that component, it still shows as if housing cost is going up when in reality it's coming down. May 10th is important because by May 10th, that whole roller coaster is now in a downward trajectory. So I think we see better indications of really where housing cost is. And you have a high all-in inflation with a high all-in shelter that sets up a really good month for seeing inflation come down. And I think interest rates, like they have in the past, will respond very positively to that just in time for the summer selling season. So again, great news, May 10th, important date for interest rates, just in time for summer. Okay, so let's switch gears now and get out of the minutia of interest rates and stuff and talk about recession. I do think there's going to be a recession in 2023. I honestly thought we would have a recession in 2022. Now, technically, we did get 2 negative GDP quarters, and that's normally a recession, but that's not the requirement. So there's actually a committee that makes up that final decision, and usually we don't know we had a recession until we're out of it. So there's a very long delay between actually calling it. It makes it easier to be right that way. So why didn't we see a recession in 2022, and why do I think we'll see one in 2023? Well, right here is, I think, a key reason why we didn't have it last year and why we won't see it this year. This top chart shows you the average credit card debt for Americans in the US. And you can see before COVID, it was cranking right along and rising, which isn't great. But again, you also got to look at this in relationships to what wages are doing. But what you can see, we had a trend, and you can see a definite complete reversal instantly. And this was huge. At the same time, down below, this is a savings. So going into COVID, before that came out, debt was going up. COVID came in, nowhere to go spend your money. Debt went down because at the same time, there wasn't a place to spend money. People were receiving tons of stimulus funds from the government. They used that money to pay down the debt and to build up their savings. So you get here to 2020, consumers were in such a great state, really low debt, really high savings. What a great time to go out and buy a house with really low interest rates. Hot market. Well, 2021 comes along, there's a reversal, no more stimulus funds coming out, feds are out of the market, interest rates go up. What did the consumer do? Did they stop spending money? No. Look at that rate. They just threw all that debt back on because now they're not getting the money. They both spent down their savings, racked up record amount of debt. We're peaking out here. And you can only go so far before you've maxed out what you're going to be able to borrow. You no longer got savings to offset it. And you're going to have to make lifestyle changes and stop spending money. So this will have an impact into our market going forward, and is, I think, a good indicator of a recession. Now, this chart here is another indicator that has 100% correlation, although past performance is no guarantee of future performance. But what this is the relationship between the 10-year, which we talked about earlier, and the 3-month. Now, you would think that if you lend money and you're committed to lend that money out for 10 years compared to 3 months, that you would earn a higher rate of return, because there's a lot more risk that over that 10 years, things can change, like inflation. 3 months, you're not too much worried about inflation. However, because of what the feds are doing to the Fed's fund rate, they're manipulating, we get what's called a yield curve inversion. And what you see is actually the 3-month pays a higher rate of return than 10-year. And it's not just the relationship between the 10 and 3. If you look at the 10-year compared to the 5-year, the 5-year to the 2-year, anything, you'll find that the less time you commit your money to, the higher rate of return you get for that. When that's called an inversion, and you can see that when that happens, every single time, here comes a recession within a short amount of time. Here's where we're at, a very deep yield curve inversion. Past performance says recession. I do think a recession is coming. But don't panic. It's okay. And this is, again, the misinformation that I think the average consumer gets is they think recession's coming. I should wait to buy because that means homes are about to go on sale. Let's delay. And I really hope that your consumers are watching this, or the realtors on this webinar convey this to their clients, that that's not really the case. And here's a good chart you can show them to make your point. The white line shows home values, and the Case-Shiller index is kind of the gold standard when it comes to measuring inflation. You can go to Zillow, all these different websites, but Case-Shiller is considered the best one. And what you'll see here is rates actually, home values actually increasing during recessions. Look at these recession periods, a little bit of level off, and then it picks up. And here's the last few ones. Now, where people get confused is they look at this one. We did in the 60s have a slight decline where we had a stagnation in home values, a little drop in the recession, then a stagnation. But other than that, since the 70s, we've seen home values actually perform quite well and not give any meaningful pullback. Now, there's always going to be micro economics in place. So you might be in a particular city or a particular place where you might feel it there, but on nationwide, this is how we see it. This is the most recent one that people go to, but it's really important to make sure clients understand and buyers understand that that was a real estate-led recession, which is not where we're at right now. We had an oversupply of housing. We had really high, and we're going to look at some charts on this in the next section. But the big takeaway here is this was a big drop in value because of what we saw as a housing crash, a real housing bubble. That's not where I think we're at, and I'll show you some numbers. But again, recessions are not a reason to be negative on housing, and it's not a reason to think that you're going to see your prices drop as a person who owns a home and as a person thinking about buying, waiting for the recession. History shows me most times will cost you more. Okay, so let's jump in now to some market housing fundamentals. So here's where we're at in the last 2 years. So people are concerned about a market crash, housing, some people, all the market's crashing. You saw that 10% pullback. There's been a lot of naysayers for the last 10 years on housing. People constantly calling for a crash since like 2016. And if you've listened to them, you've lost. You've really lost out on some of the all-time lowest interest rates, which meant even with higher prices, it made affordability better because it's a higher price. Paying $40,000 over list price in the beginning of 2021 with a 2.5% interest rate sure beats paying list price today at today's rates. But again, people get bad misinformation and they don't listen to it. But last 10 years, 115% appreciation. Last 2 years, 40. So here we are, 2.5% here. This is the end of 2022. Yeah, we saw a little bit of a pullback. But is that really surprising after a 40% jump? And is that a crash? And do we think that this trend here, this rollover, is this going to be a trend that substantiates a 10% pullback? I don't think so. And why? Well, just like inflation was key for interest rates, inventory is key for housing. Now, for those who were watching my videos last year, I had this same chart. This has been updated. But what I'm pointing out is last year, all through here, you see this rise here. The market was telling people a housing crash is coming, and they were citing the reason why the housing crash was coming is because inventory was on the rise. They totally ignored that there's a difference between active listings and total listings. So total listings were on the rise, but much larger than normal percentage of those listings were actually already under contract. So you can actually put an offer on if you wanted to. But they're saying is that inventory bottomed out. And so what they didn't tell consumers is there's a natural yearly cycle with inventory. And you can see that here. They were just focusing on this and drawing everybody's attention to that. The sky is falling without showing that, we would fully expect this. And in fact, this was abnormal where we didn't get that build up because of what was going on with COVID and low interest rates. This was normal. So we saw normality come back. I recently saw a stat saying housing market's in danger. Inventory is twice what it was a year ago. So they're using this peak here compared to here. Yes, it is twice a year ago. But guess what? It's also half of normal. And we're not talking about that. So it's really important when you're reading headlines to really dig into it because fearful headlines sell. If a consumer actually takes the time to dig into it and it's a good article, it might actually show how the headlines is anything but correct. But we all know that most consumers have, and I'm in the same boat, you got about a 3-second, before you flip it, swipe it, or whatever you do. So this is something I think is really important to understand is, they were using this as a reason. And now that this is rolling over just like in the past, they're not saying, oh, goodness, it's a good housing market because inventory is on the way down, which it is. Reports today show inventory, again, tightening up, just like we expected, but they're now focusing on the fact that it's still twice what it was last year as their negative reason. So you're always going to have haters in the market. Now, I want to talk about shadow demand. People who were doing houses back in 2007, 8, when we had the market, we heard about shadow inventory. And that was the idea that there was, as bad as the market was, as much inventory is on the market, it was going to be worse because of all the homes that were in foreclosure and going through foreclosures. Banks, go through a process before they actually bring it to market. So it was really bad. Well, this is kind of the reverse of that. I think we have what's called shadow demand. people talk about how the buyers, just aren't there. Where are they? Did Americans give up on the dream of home ownership? Do people who are getting older want to move out of their house and leave, mom and dad don't want to do that anymore? That's not the case. The demand is still there, but it's sitting in the shadow because of the fear of high prices in 21 was what made them fearful. High rates in 22 have made them fearful. But I think all this changes, and I think that this pent-up demand that you're not seeing because they're not looking for homes yet, it's there, and it's going to support housing. So this is household formation, and this is a really important thing to understand because this is what drives housing, right? We know that, and my house is a perfect example. Both my kids in 2021 moved out. So I had one house that worked for 4 people. But now those same 4 people occupy 3 homes. That's household formation. That comes from family growth. It comes from immigration growth, but it's the need to add additional housing. And what we see here is we did see a big drop off in this formation because of high rates. But the question I pose is, do you think that this drop off happened because we've seen the population decrease? So we have more people exiting the US, more people dying from the US than are coming in or being born in the formation? Or do you think this is maybe fear-based and people are putting off what they are eventually going to do anyway? So new housing supply and demand, inventory, huge reason why I do not think you're going to see a market correction in housing. I think actually we're getting near putting in the bottom in prices before we start to see them stabilize and go back up. Housing starts, this was December, we saw about 1.5 million, okay? However, every month you have about 100,000 homes that you have to replace because of fire, flood, hurricanes, whatever the case might be, a property that just basically just had to be torn down, so it was. So you don't actually add that to help with the household formations. So right now it looks like we're doing good because we have 1.4 million supplies of homes for 1.3. So we saw some inventory build, it looks good. However, builders learned their lesson from 2006. And once they started seeing demand change and rates go up, they slowed down on their production. And there's a lag effect between when a builder decides that they're going to start building something before it's actually available to the market. And that's another key thing when you're having your clients look at inventory. How much of that inventory is brand new construction that you couldn't actually move into for another 9 months? And how much of that inventory is already under contract, so it's not really available? What you really want to see is what's active, what's on the market. Now, in addition to household formations, I think come back on its own just naturally. I wanted to show this chart. I've been using this chart for years because it still makes sense. If you look at the birth rate since 1970, you can see that we have a year after year higher and higher birth rates coming to the market. And that should then tell me that if I fast forward, knowing that the prime first-time home buyers aged 34 to 37, particularly the 34 to 37 married with 1 child, they are extremely likely to buy a house. That's a formation that they need. That's real estate, okay? Well, up until 1990, each year is higher. So 37 years forward tells me that until we get to about 2027, we will have more pressure this year for houses than we did any year since 1970 of new market. After that, you'll start to see a reduction. But again, the news, will use a slowdown, and people think slowdown means negative. It doesn't mean you're going to see the market like not need it and go negative. It just means it won't be as much pressure, but still more people coming to market. But we will see very intense home buyer, I believe, first-time home buyer needs through the next several years. That's going to drive on the market fundamentals for the supply and demand inventory. Now, this is the other one. So those who want to talk about a housing bubble, housing prices are just too high, interest rates are just too high, and that's my reason for saying the housing market is going to crash. And the proof of that I'm right is also the inventory is rising. This, to me, is a great chart to help your clients understand the situation. If you are like me and believe supply and demand is a key economic factor, what you see here back in 2006 is we see a huge supply of housing, that's the dark blue line, in relationship to US population. Yet, in spite of this, we had hyper appreciation. We're seeing appreciation not as hot as we saw the last 2 years, because rates were like, 6.875% at this time, or 6 to 5, almost 7% right in here. But what we saw was values going up because with really crazy lending rules, people could state their income. And with popular TV shows about fix the house and flip it and make a bunch of money, everybody was trying to do that. And so we had a bunch of people who couldn't afford one home buying 3 homes, doing minimal fix up to turn around to sell it for a profit. And once we got done selling it back and forth to each other, and there was really no demand for it, you saw a crash. And here's your pop. Now back here, you saw a huge oversupply, but you didn't see the same kind of pop because you didn't really have values going up. You saw values kind of stagnating because we had too much supply and not enough demand, but the lending rules weren't as crazy. But this allowed for that. So this is a pop. Look where inventory is now, and look where the population growth is. I just, I always tell people, if there's a bubble, I got to think it's the population. And I just don't think we're going to see a massive depopulation or people actually change our cultural preferences of having our own home and not being multi-generational. You have a few people that do that, but I just think as a whole, US people want to own a home, and there's not enough homes. So I just have a very, very hard time of seeing any type of meaningful reduction in home values when you have such a disparity between actual demand that might not look there now because of the shadow, but there's just simply no inventory. And with higher interest rates, this gets worse for 2 reasons. One, we talked about builders. Builders slowed down, they put things on hold. Once they turn that back on, there's a lag effect, but yet buyers are still trying to buy. And those sellers who like to move across town to nicer neighborhoods, maybe upsize or downsize, because they're sitting on a 3% rate, it doesn't make sense for them. As much as they want to move to a different house, they can't justify stepping away from a 3% rate to a 6% rate. And so until those rates come down, you're going to see a point where buyers want to get in the market, but builders haven't been there yet, and sellers aren't quite willing to let go. And you're going to be in the same kind of crunch we felt in 2021, where you just didn't have a lot to choose from. So that's what I think. So drum roll. What do I think? Housing forecast. I think lower inflation throughout 2023 is positive. I think the recession-like slowdown, while that seems negative, it actually, history shows me that it actually supports housing because rates go down during recessions because of inflations, and lower rates make housing more affordable, and more affordability, you see next thing, dries up inventory. So inventory is tight, and with tight inventory, rents, I think while rents, housing shelter is coming down, it's not going backwards, it's slowing down, again, not negative. But I think when you start to see what the options are between buying and renting, I think all these things are strong. So drum roll is, I think that we still see at least a 5%. I think we're gonna be a 5% year over year from January 1st to December 31st, 5% rise. That's a normal, healthy rise. A lot of wealth is created in that. And so even though we might be addicted to the 15 to 20% or 10% rise in values, that's not sustainable. It's not healthy. 5% is. Great time to buy a home and get 5% return. Now, for rates, there are going to be some headwinds. With all the debt that the governments have been giving out, all this stuff, not debt, but stimulus, governments around the world are going to have to finance that debt. They're going to issue more treasuries and stuff, which compete for the dollars that could go to the interest rate. So that could compete. That could be a little bit of a headwind. And there's going to be some global tightening, quantitative tightening around the world that, again, on one hand will be beneficial from the recession standpoint, but also means maybe fewer dollars coming in from foreign countries to help. But I think we have more tailwinds. I think lower inflation is key. I think increased values. So that mortgaging chart, the very first one, as rates come down, servicers are now willing to pay more. So you kind of get this like acceleration as I'm getting that lower rate, but now all of a sudden these higher rates on the rate sheet actually pay back credits. So that will be really good as we get down in that 5% range. Servicers will, I think, come back in full force. Recession likely, so rates drop in recession. So again, all this stuff is kind of feeds on itself. So I think that we will actually see rates near 5% during the first half of 2023. So I think by June and July is very likely to see rates at 5% if inflation continues to come in. Watch that May 10th date. We were basically high fives just about 3 weeks ago. And so, yes, I think that we can get to that. So what about affordability? Because this is a big question people have on affordability. And again, a lot of misinformation as headlines chooses what number they want to look at and say it's not affordable because home values are too expensive, ignoring the fact that rates went from 5% to 2%, 2.5%. But that's all they focused on was the values of the home, not the payment. And then when rates started going up and values stabilized, it's not affordable because of that. So let's take a look at here, affordability. Let's just say last year a borrower gets a loan price and they put down payment, they got $400,000 loan amount, rates at 3.5%. That's kind of where it was in January a year ago. There's your principal and interest payment. Now let's say fast forward a year today, 10% higher. So you're going to put that all on the loan. So now it's a 440 loan amount. Rates are about 6.25%. Pretty close to where we're at right here. So these are good numbers. 913. This obviously is not affordable, right? As a percentage of where you were at, this is what we're saying is it's just not affordable. But is that really the truth? Is that the complete picture? Well, let's take a look at income, because this is really, it's affordability. It's a case by case question to begin with, what your income is. But we got to look at the change of income compared to the change of debt. So according to ADP, which does over 25 million paychecks every single month, so they have a pretty good pool to know what's going on with wages. They said that employers last year that stayed at their job got about a 7.6% raise. Those who were willing to change jobs actually saw their income go up by 15%, but on average income for that 25 million went up 9%. So if I apply that 9% here, we now see that $810 increase in income. I've offset a lot of this. So no, it's not as affordable as it was, but again, not being as affordable is not the same thing as being affordable, which is this huge confusion. Now, let's be honest, going through the year, I'm paying more money for that, but I also got to pay more money for gasoline. So part of my $810 is going to be used up for higher gas, higher food, higher services. So an average household might see their total expenses year over year go up by that, 1154. However, if you buy your home now, you lock in that payment. If you only get a 5% raise next year, so about half of what we saw last year, you're now at about a $1,300. So you've actually have come into a better situation. Whereas if you continue to rent, that rent continues to go up. So affordability, you can just never quite get there. But that's one of the nice things. While buying a house at first can feel a little bit tight, if it is affordable, which again is based on your income, not what the market says, over time, that payment gets more and more comfortable because your wages go up and you've locked in your single greatest monthly expense. Unless you bought a really expensive car, then that might be another one. So going forward though, so what happens if I buy it today, I have that higher payment, by the end of the year, I'm in 1154, I get my raise, but now rates drop, as Josh just said, rates go down. Well, if you do that and rates do go down, then you get the refinance. You lock in today's pricing, you get the future interest rate if it comes, and you get the best situation. If rates don't drop, you still get the benefit of having locked in that payment, because over time, I still think even in a flat rate market, home values are not going to go down. Why? Supply and demand. There's just not enough supply to justify any type of imminent crash, as that one interview said. So how do we get our clients to really understand? And I know I'm coming up on 45 minutes. I'm going to go through this really quick. This is something I do to help my clients understand the benefits between buying versus renting, even if you're paying $700 a month more for your rent to own versus rent. People get this wrong. We talk about the benefit, but there's very few people who can find a way to articulate this to the buyer so they can see their personal. And this is something I do. I customize for my clients. They can see their scenario. But here we're doing a $500,000 purchase price. We're going to put $25,000 down. And because we're in a more favorable balanced market where sellers are negotiating, we're going to say the seller pays all closing costs. So what we're going to look at here is, even though you see that over time your rent payment was $700 more, and we take into account that you're going to pay taxes, you pay a higher homeowner's insurance, you have to fix things when it breaks. We put all this into it to get to that $700 difference. We take into account what you're going to pay to get out of the house, all these closing costs, and we can manipulate. If you're buying a more dilapidated house, we can put higher monthly costs. If it's brand new, we can put lower. But needless to say, this can get very specific to make it very meaningful to the client. And what you see is, yeah, day one, it's cost more to own, but over time, those rents go up. At the end of 9 years, the owner shelled out of pocket $22,000 more. And this, again, where people think I should stop, I shouldn't own, I should rent. But what they don't realize is when we talk about the value of appreciation, what does that look like over 9 years on 500? Well, here you can see the home went up at $300,000 over a 9-year period. You put $25,000 into it. Amortization gain, this is a really key one here. As you make a payment on your mortgage, you reduce the balance of your loan. So even if you sold a house at the same price 9 years from now, you have a loan amount $65,000 less. So that's cash you get back. You don't get anything for the renter. So in short, what we show them is owning versus renting, even when it's $700 a month more out of pocket, you actually make $300,000 based on these projections. And this is, again, we can change rates and all that kind of stuff. We're using about a 5% home appreciation rate. And you don't have to be in it 9 years to beat the renter. Even in just 3 years, you do. That's almost 120% rate of return on your $25,000. Does anybody on this chat box, if your 401k is beating this, can you let me know who your provider is? I would like to talk to them on that, because I think that's a pretty amazing return on investment. Let's actually return it. So now I just Googled average rate of return for the S&P 500, and I came back at 10%. Actually, no, it was 8.5%, I believe it was. So I'm using 10%. So you're beating the S&P, put the same $25,000 into a stock account, hold it there for 9 years. You sell it, you get about $59,000. Which of these would you like for that? In exchange, you get to own a home you like. You can paint it. You can have as many pets as you want. All the benefits of home ownership, and you've turned your $25,000 investment and your monthly $21,000 a year, take it all into account. You've turned that into $300,000 versus $60,000. Now, I'm not a tax person. I'm not a financial advisor, so I'm not giving this advice, but I understand current tax laws to be if it's a primary residence, you've owned it for 2 years and you sell it, no capital gains, tax-free money. Here, you're going to pay taxes on your tax break. So again, something to understand, that buying at today's values with today's interest rates, when it costs you more to own than to rent, turns it into an investment. So you need to understand that owning a home is not like buying a car. It's not like having a credit card debt. And you might want to talk to a financial advisor, and does it make sense maybe to contribute $400 per month less to your 401k to be able to afford a house that allows you to get this type of return, looking at historical returns. Now, the last thing I want to do is about cost of waiting. Then we're all done here. We can jump into chats. The cost of waiting analysis here, what this shows is even when we put in projections of what I think rates are going down, I think home values are going up. We can see that even if you wait for lower rates over time, because home values are going up, in short, it costs you more money. Yes, if you wait a year because of the lower rate, you do save $200 a month off your payment. So again, misinformation, the consumer thinks I'm being smart. I'm going to wait, save $200. But what they don't realize is they gave up the $25,000 equity that they now have to pay. So they paid that in a price. It still gave you a lower payment, but that could have been your $25,000. Also, during that time, you've been paying down your mortgage, but you haven't done that. So it actually cost you $30,000 to save $201. Well, you can't spend this much money, but what kind of interest rate would you get today if you were able to put $30,000 down and buy your rate down? Pretty phenomenal rate. I think the key here is not to wait. I think even 6 months, when you look at the fact you do get a lower payment in 6 months, it costs you $8,000. If I'm right and values continue to go up, if I'm right and rates go down, if you want to win at this game, you buy as soon as it's affordable. When rates go down, you take advantage of a rate term refinance. Those refinance costs, if you're not paying discount fees, you're probably looking at about $4,500. Check with your lender. This is not a rate quote or anything like that, vary by state. But maybe $4,500 if you need an appraisal. If you don't, maybe $3,800. Wouldn't it make sense to buy it and pay the fee to refi? I think so. So that's it there. I hope you guys enjoyed the presentation. Again, I'm going to figure out here to just turn off the recording here, and then we can jump into the chat box. I see we have a few chats. And for those of you who are on the call, thank you so much. If you have questions, reach out to me, and have a great day.